All right, hey Mark, if you're ready to go, I'm gonna give you your 2-sentence intro so we know where to clip this recording. You can find our 6th presenter at Right Line Trading. Please welcome Mark Sachs.
Hey, thank you so much for having me this evening. Just a quick disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Right Line takes no responsibility for losses in the futures, forex, or stock markets. And we obviously caution that risk with trading is substantial, and it should be understood that a person can lose a substantial amount of money. Therefore, be ultra careful. Careful consideration. Your financial position should be made prior to trading. Never risk more than 2% of your account on any trade. Do your own due diligence. Consult a financial advisor. And Right Line Trading, we are not registered financial advisors. We are not licensed commodity trading advisors. And you may want to consider talking to one before making a trade. And with that said, what I'd like to do, just a little bit about myself. I'm a former professor at Jefferson Medical College, and I have an extensive background in finance. And what I really wanted to talk to you today is about the oscillator. Now, the oscillator, I think, is an extremely misunderstood indicator. And over time, because of the way the markets have changed, its use has also changed. Now, George Lane created the oscillator back in the 1950s. And what I believe he created was stochastic. And it really was an amazing tool when he created it. And George Lane, I did a lot of reading about George Lane and about his life. He was really a brilliant guy. It's interesting to note that he died poor, but he was a real smart man who came out with a lot of other mathematical derivations. Now, before him, the only indicator that was present was a MACD. Now, the thing that both of these indicators have in common is that they are second-order derivations. And what they do is they measure the rate of change of a specific metric. And what they both do is they measure momentum. And momentum is a second-order derivation. So what they're doing is they're looking at the speed of change of price. And I'm going to go into that more. But his postulate was that anytime you're looking at a second-order derivation or the rate of change of some parameter, it had forward-looking ability. So it would change before price did. So his major thesis was that the stochastic oscillator could be used to foreshadow reversals when the indicator revealed bullish or bearish divergences. He did not use this as a tool to trade the trend. He used it as a method for trading divergences. And it was really one of the first, and I believe the most important trading signal identified, and that was divergence. Now let's talk about it just a little bit more. Now, momentum measures the rate of change of a security or financial instrument's price. As the price of a security rises, momentum will increase as long as the rate of rise continues to go up. The faster the security rises, the greater the period over period price change, the larger the increase in momentum. So if a security is moving up at a constant rate, momentum is not going to increase. It has to move up in price in a geometric fashion, not an arithmetic fashion. And once this rise begins to slow, even if the price is continuing to rise, momentum will also slow. and as the security begins to trade flat, momentum will start to actually decline. Now, let's look at, if we look at the oscillator calculation, we get a little bit of insight into it. And there's only 5 parameters that are present on any given chart. Now, the assessment of volume has become very complex. There's volume ladder, there's market profile, there's all kinds of ways of looking at volume, but there are really only 5 metrics. There's the open, there's the close, high and low of every candle formation, and then there's volume. And those 5 metrics can be placed into different formulas, different indicators, which mathematically create a line based on those 5 parameters are cranked out. And what the oscillator looks at, now if you look at the formula, C is the most recent closing price. Now L14 is the average low of the 14 previous trading sessions or candles. H14 is the average high of the last 14 periods. So the percent K, which is the key metric or momentum metric, is based on how C closes. Now if C, which is the closing price, continues to approach the high of the move on a long trade, momentum is rising. If the close of the candle continues to approach the low of a candle on a down trade, then momentum is increasing to the downside, and the percent K line will fall or it will rise. Even if the price of the stock or the future or the Forex pair continues to rise, if the close starts to back off from the high, on a long trade, momentum is going to start to turn. So again, in a market trending upward, prices are going to close near the high. And in a market trending downward, price is going to close near the low. And that's what creates the percent K. And the big signal is when the percent K simply crosses the 3-period moving average of percent K, which is percent D. Now, what George Lane was looking for back in the 1950s and 1960s was divergence. And that's when price made an equal high or a higher high, but it made it on lower momentum. So although price approached the high of the previous move, the close of the candles did not get as close to the high of the candle as it did previously, signaling a drop in momentum and a likely collapse in price. This is all that George Lane was looking for. He was looking for a divergence signal. And here's the same example I took off of our charts. And here's price making a higher high. Now here's stochastic making an equal high, which is also divergence. And it heralds a collapse in price. The problem is that lately, and when I say lately, we're talking about the last 5 to 10 years, divergence has become a very, very iffy signal. Now, when George Lane first postulated it, I don't have data going back into the late 50s and early 60s. My guess was that it was a very, very successful signal, and that divergence worked a significant period of the time. If you do an analysis of divergence now, you'll find that it's going to call some tops and it's going to call some bottoms. But if you try to trade it on falling momentum, it's really, really going to beat you up. there you're going to see as I proceed with the talk, and I want to keep track of the time very, very, very closely, is that, and I'm trying to make sure I know how much time I got left, is that the market has a completely different paradigm now. Now, this is another divergence failure. You can see that price is making a lower, stochastic is making a lower high here. And here's the higher high. But if you traded it, you would get a little bit of a fall, and you see that the market price just continues to rise. Right back to its previous high. No real collapse. And I could have shown you a much better example, but I want you to see that over time, the divergence signal doesn't really carry the strength that it used to carry. Now, in trading, here's how we would like stochastic to work. Every time we get a cross of the %K line across the 80 line, which is the overbought line, price is going to fall. Every time we get a cross above the 20 line, we get a long signal. We get another long signal here. It's just blocked. This is just charts by TradingView. I just took this right off the internet. There's nothing special about this chart. Get a cross here of the %K on the 20 line, you go long. You get a drop across the 80 line, you go short. And here is a drop across the 80 line, short and long. The perfect way for stochastic to behave. And here is simply, what this simply demonstrates is that overbought doesn't always mean overbought anymore. And that when you look at the price of a financial instrument, and you look at the stochastic as it crosses the 80 line to the upside, 20 years ago, traders used to look to fade the price of the market and go short. If you do that now, you're going to have a tremendous problem. And here, I think, is what's happening. And here's why you have to use oscillators differently. And we've taken all of that into consideration when we created our modified Laguerre. Our modified Laguerre is not created to track divergence. It is created to take a forward-looking approach to the trend and in an attempt to trace out the footprint of big money. George Lane's indicator and all the subsequent stochastic derivatives, like Williams K, like RSI, were all meant to look at divergence. We've created the first indicator to pretty much ignore divergence and look simply at tracking the trend and getting in at the most opportune time. Now, again, when oscillators were developed, there was little institutional volume in the market, and that's really the key. Now, the key is if the power of each buyer was approximately equal to the power of each seller, then a divergent signal was really, really a good signal. If momentum was falling and price was making an equal or higher high, since there was equal power on the buy-sell side, then likely the power of the buyers on a long move had waned and price was going to fall. Same thing on a short move. The problem is that now institutional volume and money dominates the market, and that's what determines the direction of price. Now, this is the same reason why Japanese candlestick formations, which 15 years ago were extremely powerful, have lost a lot of their value. It's simply because when institutional money steps in, it skews the market. And I'm going to take that even a step further. The natural harmonic of the market as traced out by Gann theory and Elliott wave theory, are also obliterated simply because institutional volume is becoming a larger and larger percentage of total volume. So if that's the case, we have to change the way we think about these indicators and change our mindset and understand that the small guy is no longer in control. And with that, we have to trade these indicators a lot differently. Now, here's really the rules I would set out on how to trade an indicator like this. There's no such thing as overbought or oversold now. This is now a fallacy. The market is overbought when the institutional traders say it's overbought. They can, we trade crude oil and the NASDAQ every morning in the live trading room. And this morning, we got 3 trades on the NASDAQ, one for 9 points, one for 8.25 points, and one for 6.25 points. Those are the only 3 trades I took. There's no such thing as overbought or oversold. The market is going to keep going long or short as long as the institutional money is there pushing it down or up. And markets are going to reverse at the whim of institutional money only. It's not going to reverse on the basis of a divergence signal. Divergence worked great 20 years ago. It is not going to work anymore. Occasionally, you're going to get it to work, but the vast majority of times it's going to fail, and that's not an indicator you can trade profitably. Now, reversion to the mean is still a strong force, but again, that concept has been skewed, and price will revert to the mean when the institutional traders stand aside. Price is going to come back to the mean. So trading divergence is tantamount to trading against the flow of institutional money. And the only thing that we can do is trade in the direction of money flow. Whoops. So which indicator most accurately assesses buying and selling pressure, completely ignoring any potential divergence signal? Well, it's one that's been tailored specifically to do that. So with it, you're following the footprint of big money. Because that's all an indicator can do now. And it has to do it with incredible precision. So here's the easy language code of the Laguerre. Now the Laguerre is it has a tremendous ability to be modified. It has a gamma, which determines its sensitivity and specificity, and also has multiple filters that can be used. So our Laguerre is proprietary. We've set a specific gamma based on a 1-year, actually forward-looking assessment where we do a year of market replay data. And we've set these filters to provide us with the best trade-off between sensitivity and specificity. And now, if we look at the Laguerre, what we're going to do is we're going to look to trade in the direction of institutional money. Now, there's very few rules we have to employ when we trade. One is we only go short below the 50 and only go long above the 50. I mean, it's my thesis, and I believe it to be accurate, that when the market is above the 50, the bulls are in control. When it's below the 50, the bears are in control. If you want to take a long trade below the 50, it's a counter trend trade by our definition. You want to trade short below, and you want to trade long above. Now, here's the Laguerre signal. And the Laguerre signal flashes an arrow on your chart right here. And that's the Laguerre line crossing below the 80 line, telling you to go short right here. Now, when you get to oversold, all the other indicators, all the other oscillators are looking to fade the market. We created a very smooth analysis, and we get this this oscillator bar or Laguerre bar shows that the Laguerre is locked short. And it tells you that the only direction you can trade is short. Now, back 20 years ago, this would tell you you're looking for divergence and a move to the upside. What it tells us is that the institutional money is firmly in control of the market. The oscillator crossed below the 20 line here. Your entry is here. It locks down here. And the only direction you can trade is short. Now you get the same move here, but it's a counter trend move and we don't trade it. We get the same trade here, short. The cross of the Laguerre line with the oscillate with the 80 line, you go short. The Laguerre locks down, and you get a nice short trade. I mean, that's what the Laguerre is looking to do. You can trade it short here, and trade it short here. I'm sorry, these are these are long counter trend signals. Here's another example. Now I want to compare it to other indicators. Now the bottom indicator here is stochastic. Now here's our Laguerre entry short. Now you get in here with stochastic, right here. On the cross of the 80 line, the %K line crosses the signal line, and you're in. But it's meant to track divergence. So it quickly, these two candles, push it right above the 20 line, which is a signal to exit the trade. So you're out of the trade after a very small move. But look at the Laguerre line. It's locked short and allows you to take this trade all the way to the bottom, because we're looking to track the direction of institutional money and track money flow. And you can see the terrific short trade. Got a little bit of movement on the Laguerre, but not nearly enough to take us out of the trade. We also have here, this is called fractal energy, and it's also an optimized parameter that gives us some idea of volatility. When this yellow line rises, the potential move on an entry is long. And you can see how the yellow line rose into this short signal. It tells you that the probability of getting a long move here is good. So you want to see that yellow line rise into your entry. Now here's another example, and here is the Laguerre modified against RSI. Now in this entire move, there was not one single RSI entry. If anything was used to track divergence, and now the RSI is a modified stochastic by definition if you look at the formula. It just does not work for me, and it doesn't work here. Here's your long signal. Above the 50 and up you go. Here is your long signal. Market's locked long. You can take any retracement long and up you go. So you get two perfect entries here and here, both in the direction of the trend and in the direction of institutional money. When we see the Laguerre lock long, we don't look for a counter trend trade. We look to go long on any small retracement back to support. And you'll notice here is RSI divergence. And if you took divergence on the RSI, you would be taking a counter trend trade against the flow of institutional money, gotten completely beat up and knocked out of the trade, while the Laguerre would have taken us right in and run you over and taken out all your stops. Now, I'm getting really close to the end here. So I'm going to have to skip a lot of slides. This is the last slide I'm going to show you. Here's another long entry on the Laguerre. Now the long entry and this is Williams percent K, comes a little earlier. But as you move up, the Laguerre locks long and keeps you in the trade. But look what happens to the Williams. It falls below the 80 line. You're out. Falls below the 80 line. You're out. Finally, you get a move out. But the Laguerre locks long, tracking the flow of institutional money, and keeps you in this trade all the way. You're out on this down candle, where finally the Laguerre breaks short on this below the 80 line. You're out of this trade real early on Williams K. Now, I wanted to go to the live charts. I don't have time. We're at www.rightlinetrading.com. Info at Rightline Trading. Our number 786-713-5276. The Laguerre is an essential component of our trading analysis. We only trade in the direction of institutional money. Now here is our offer. This is the webinar special. Now normally the Laguerre is $6.99. We're giving it for $2.99 on a lifetime license with free updates. Our next update is we're going to turn it into a multi-time frame analysis. You're going to get that for free. The buy link is at www.rightlinetrading.com/modified Laguerre. And the first 10 get a month in my trading room. And we make money almost every day. We're only on Tuesday, but we're up a lot of money already this week. And we trade the NASDAQ and we trade crude. Now, Rory's at the phone on 713-5276. Now, that's it. I mean, I have a lot more information, but I'm obviously it's 7:50. So I have to end. If I can answer a couple of questions would be great. And I'm going to end here, though. I think I've used my 50 minutes, my 40 minutes. Hello?
Hey guys, if you got any questions here, we'll finish up with these questions.
Have I gone 40 minutes? I'm so bad with the clock.
I only went to 30 minutes, but so I mean, if you got another 7 or 8 minutes worth of information,
Yeah,
you're welcome.
I do.
To give it.
Yeah, let me
You
show.
can read the questions here too. So.
Okay, let me show you a live chart. And this is a live chart. It's complicated, but it compares all three indicators: the Laguerre, stochastic, RSI, and Williams R in this case. And it looks at entries and exits. And let's take an entry. Here's a good one right here. Now here's a long trade on the Laguerre. You can see the signal long. The 50 is green, the 15 is green. We're trading above the 50. We get an up candle. I mean, we get a break of the 20 line to the upside. Now the stochastic line gave us an entry a little bit earlier. And in this particular case, it's going to take us out at about the same time. RSI is going to take us out earlier, and Williams R is going to take us out much earlier. Once we lock long on the Laguerre, we are going to continue to ride this trade long. This single candle pullback, we're simply going to stay in the trade. Now here's a short entry right here. Now you can see you get a move down across. Now you can see that the fractal energy line has come way up, anticipating a really nice long move, a short move in this case. You get the down signal right here. Now you're already in the trade early on stochastic. You're in a couple of candles early. But look what happens with the top line stochastic. you're right out of the trade on these 3 up candles and gone. So you got a minute piece of this down move. RSI never gave us an entry. Williams R gave us an entry and then took us right out, where the Laguerre dropped and then locked short throughout this entire move, giving us the whole move to the downside and not taking us out till we get this up arrow. So we were able to take this trade on Williams, on the Laguerre, from the entry here all the way to the arrow here, where every other signal took us out here or took us out here. This is because this is formatted differently and the code inside the indicator is differently. It's a great entry tool and it keeps you in the trade for a significantly longer period of time. Now I'm looking at crude. I could show you any instrument. And I think what I want to make it clear is that this works on any time frame and on any type of candle. It makes no difference at all. Now look at this short move right here. This is at 10 a.m. You get a perfect entry on the Laguerre. You get no entry on stochastic. You cross over, but you're way below the 80 line. So this move is not coming from an overbought position. You get no signal on RSI, and you get no signal at all on Williams R. The only oscillator that gives you a short is the Laguerre. And then it locks short here, gives you this entire move to the downside, and you're out on this arrow right here. If you were trading any other oscillator, you would not have gotten in and been able to ride this trade all the way down. And like, again, that's because they're formatted to look for divergence, not to create a smooth pattern when money flow is just crushing price to the downside. It's a completely different type of analysis. Now here's another, I could do this, here's another one right here. Now this one is going to take you out because you get the up arrow. You're in here and you're going to be out on that up arrow. But you're going to be out sooner on every other indicator. We don't take counter trend, and we don't trade short above the 50. We have to wait for a signal to adhere to our rules. Here's a short trade. Stochastic, no entry. Look right here. And this is the last one I'm going to show. And then I'm right here. Now, here's the 20 line. So you do get a short signal right here. But it's going to take you out here. This is not a bad signal on the stochastic. The problem is it never locks down. And that's what you want to see. You want to see eventually this lock down here. And the exit out of the trade is a lot faster. You get no signal on RSI, and you do get a short signal on the Williams R, and here you get a pretty good exit too. This one, pretty comparable. But most of these trades are going to get you in better and keep you in the trade longer if you trade a signal off the Laguerre. And I could do this on any time frame and on any financial instrument you want. This is time frame independent and instrument independent. So again, so here I'm going to stop. That's a live chart. And the only thing I'll do is, well, I'm not going to show you the E-mini. I just don't have the time. On the NASDAQ. But we took 3 great trades on the NASDAQ. All of them long, with the Laguerre lock long. They kept us in the trade for 9 points, eight and a quarter or 8.5, and for 6.25. Great trades, and that was all we traded. Those 3 NASDAQ trades. So if there are any questions, let me know. Be happy to answer anything you have. Any questions out there? Let me see if I can see them. Hang on. Hold on. Let me drag over here. Okay, okay. Got it, got it. Lance, I really like trading the E-mini. This is early in the evening. Let me go all the way to down here. Okay, hang on really quickly here. I started at 7:20, so let me go to the questions past 7:20. Okay. Soon, AD. Very soon we'll be releasing the multi-time frame Laguerre. It works on individual stocks, John, really, really well. It will format itself. All you got to do is put it on the stock. I don't have time. I have a stock data feed. I wanted to do it. If I had more time, I'd show you Google. I'd show you Facebook. I'd show you any stock you want. It's going to give you. If I didn't tell you that we were trading crude oil on that chart, it will look identical whether you're trading Forex, futures, or stocks. It is irrelevant. And let me just say one thing. If an indicator is not time independent and instrument independent, then it really isn't a valid indicator. If it can only trade stocks but not Forex, or trades Forex but not futures, it's broken. Because all we're looking at is 4 parameters or 5 parameters on every chart. The open, high, low, close of a formation, and with some indicators we're looking at volume. They're the same on every financial instrument, and they're the same on any time frame. So if you're told an indicator is instrument specific, there's got to be some flaw. It's not available for TradeStation, Elia, but you can set it up and we'll do it for you. You could set it up on a demo of Ninja and run it for free. TradeStation, we can't do that, but you can run it on a demo and take the signals right off of it on Ninja. We plan on moving into TradeStation soon, but right now it is not. But we have a lot of traders on TradeStation who do take the signals. Listen, Peranders, the Laguerre is an oscillator. I mean, at its core, it's based on the same thing as every other oscillator. The relationship of the high of a move to the close and the relationship of the low of the move to its downside close. That is true of every single oscillator out there. But the Laguerre is a lot different when it's formula-based. Has a gamma, which none of the other indicators have, and has filters. So it's a lot more sophisticated. Williams percent R and RSI, Jeff, are not. If you Google their formulas, you will see that I think they're different. And if you look at the way they trace out on the chart, they're very different. I'll just put them back really quickly. But here's RSI, and here is they look. You see the difference here. They are not the same indicator, and you see here RSI is rising, and Williams R is flat. So they are using different formulas to create their lines, to create their oscillator line. This is formatted for NinjaTrader 7 or 8. But if you have TradeStation, if you have Thinkorswim, Thinkorswim will actually run this indicator, but you have to run it on Ninja. This is great for a choppy market, Alan, because you're not going to get it locked long or locked short. You're not going to get a Laguerre entry. It's really going to help you It's going to help prevent problems. And here we are in the trade room today, $440. And we only trade a very small number of contracts in the room. Thank you so much, Rory. Yes, Brian, it's going to become available shortly, the multi-time frame. John, it's simply going to, we're going to keep it one line, but it's going to look at data from a higher time frame to provide it with more forward-looking ability. Yeah, Jeff, if you use any other kind of oscillator or you use some other exit, you're going to get bounced out. You follow that Laguerre lock and it will keep you in a trade. And you wait for the cross and the exit signal. It's going to keep you in a trade a long way. It's the only way we got 9 points on the NASDAQ. Our stops are a reversal candle. Our reversal candle on the NQ is fairly big. It's about 20 ticks. Our reversal candle on the E-mini is 11 ticks. Our reversal candle on crude is 13 ticks. Our reversal candle on stocks would depend on what stock you're trading. But our risk to reward is excellent. Listen, only big money can lock the Laguerre long or short. You cannot get institutional traders to lock this line long. They don't have the power. And they don't have the power to lock this line short. Now, every other oscillator is looking for divergence when you're locked short. We're looking to ride this short. So when you see this trade, when you see something like this, the price is not rising by accident. It's because the institutional money is pushing this up. And the Laguerre is simply tracking it. Now, we don't have an entry, but we have an absolute direction to trade. Here, we got the crossover, and we got the lock short. So we know the only thing that can lock the Laguerre short is big money. Now, there's no way any indicator can directly tell you that big money is involved. All we can do is follow its footprint. And this is a great footprint of institutional money. It's not, again, Elia, you're going to have to use it on Ninja. We can format the whole thing for you. And you said you were thinking it was not worth it. No, we're going to do it, Harry. Yes, we are going to. No, it's not up in the air. I talked to Sergio today and we're going to proceed. Who is Laguerre? Laguerre was a mathematician and a really, really smart guy. I mean, he created Laguerre transformations, a whole series of mathematical derivations. And one of the things he created was this Laguerre oscillator. Both him and George Lane were not really market guys. They were both, at their heart, mathematicians who wound up creating these indicators. I don't know where they dropped out of the sky, but if you Google them both, you'll find that the majority of their work is not in the market. TradeStation know directly, Elia. It's got to be only indirectly. I want to be honest with you. Again, Igor, it'll work on 4 range. It'll work on 8 range. It doesn't matter. For a long time, I traded it on range. We trade it on Unirenko now, which is very similar to range bars. It will work great on range bars. My Unirenko, Mike, is a 10 to 5. But remember, the Unirenko entry or setting depends on the instrument. Whatever you trade, we will give you the setting for the optimal setting. So don't worry about that. That comes with it. Whether you trade crude, the pound dollar, or you trade any stock from a $2 stock to a $1,000 stock, we'll give you the Unirenko entry. Brian, I don't know exactly, but Sergio is working on it. Well, listen, stock options, Jeff, The best way to trade them is know the direction of your stock. You can, if you want to day trade options, and let me tell you, this works great on the Q and the SPY. If you want to take an in-the-money call and look for a buck or so move on the Qs, this is a great way of riding the Qs up. I just don't have the time to show you the Qs, but the Qs are going to behave identical to what I just showed you. Identical. It does not run directly on TradingView, Randy. Only NT7, NT8. Again, Elia, no on TradeStation. Not directly. You're going to have to use it on Ninja and take the signals on TradeStation. Thinkorswim will run it, Jeff. That's the difference. On TOS, we can take the data feed through an API and run NinjaTrader for free forever. So basically, your Thinkorswim data feed on either stocks or futures or Forex, whatever the Thinkorswim data feed has, will directly power your Ninja. But you're going to have to look at the Ninja chart. But unless you're trading something that's very quick, it's easy to take the signal off a Ninja. It's a little more complicated, but I'm telling you, it's going to get you in and out great. No problem, Elia. No problem.
All right, hey, we got to wrap it up.
Okay, sure. Thank you for giving me all this time. I really appreciate it.
Video's processed here. There's a shot for me to get it out tonight, but I have to finish in a few hours.
Sure,
So I want
sure.
to thank everyone for joining us. I want to thank Mark for joining us. And the link to his products right there in the chat. And also you'll be able to get it with the video as well. And I'm going to try to have the videos for you guys in 6 hours here. If I can get them processed. If I can't, then you'll get them in 24.